All right, guys, what is up? Welcome back to the channel. Today we're going to do a little special segment. I guess throughout the whole week, we're going to do a little special segment called Blast the Banks, where I'm going to go through, show you in the financial reports what's going on with all these banks. We hear all these things that are happening. Oh, they're in trouble. They're trading at basically all-time lows relative to the S&P 500. So I'm going to walk you through all of the nuances that are going on with these banks right now, and also too, I'll provide some charts in the links and in the videos that show, all of the metrics, or at least the key metrics at this point, that you all should be looking at to better assess where these banks are, what the problems they have are, and how management is thinking about all these things as they move through time, and what they really need to do or what they can't do. So let's get into it. I thought first we would start with Truist Bank. I'm really going to focus more on all the large banks in this series. If you want a particular bank done, let me know. I'm happy to do it. But I figured I'd start with Truist. That's a pretty good one. We'll do JP. We'll do Citi. We'll do all the fun ones. So let's get into it. And this is the 930 financial reports, the 10Q from the SEC.gov. So everything I say in this video is public information. I'm not breaking any laws. There's no insider information. I am just presenting to you what I see and providing my opinion. Obviously, this is for educational purposes. Don't sue me. So here we go. Let's get into it. So let me pull up my little chart here on the side. And like I said, 10Q. Okay, so I've outlined a bunch of different things on my side before this video that I'm going to walk through, mainly being what their securities are to how much shareholder equity they have. Do they have these federal home loan bank loans? What's their cash to their deposit liabilities? And really, the whole goal of this is just assessing what all of their balance sheets look like, excluding their credit loan books. There hasn't been any really material pickup in any of the credit books. And that's really what the Federal Reserve is trying to do. They're trying to take this issue from a interest rate issue, via inflation. That's what's causing the rates to stay up because inflation is persisting, to a credit risk issue. So they want to, again, take the stress off the system and they want to put it on the people or on the businesses. So because that's what 2008 was all about, was the credit, and they know that they have the robust controls in order to better manage and maintain that situation. Right now, all these banks are blasted to smithereens from a solvency standpoint, and they're trying to figure out what to do. And again, the higher rates go, the more these loan books are losing value. And if you really think about it, they're just getting levered to crazy amounts because their total reserve capital is dwindling because, again, these securities they thought were their golden collateral, their golden reserves. Well, if your reserves go down and your leverage stays the same, your leverage ratios and everything are going up. So let's get into it. So first, let's look at securities. How much available for sale and how much held to maturity securities these banks have relative to their stockholder equity. Because again, if these rates keep going higher and that shareholder equity goes to zero, these banks are done. Why stick around if there's no equity left in the game? So let's get into it. And so we just scroll down here just so you have your obvious your table of contents here, but I already know because I did the work. We're going to page 4. So we scroll down here and boom, we're in the mix here. We're in page 4. And as you can see in the asset category right over here, that their total securities right now, and they also have trading securities, but they're small amounts. We're not really going to focus on those because it's only 4 billion, so we're not going to worry about that. But they're available for sale, and held to maturity securities are roughly $125 billion. And again, the available for sale securities, those are at fair value. Those are constantly getting marked to market. The held to maturity securities, those are not. Those are being run through other comprehensive income. So you have two different, balance sheet treatments going on here. So some of the metrics I'm going to post are going to be a little different. They might even be a little off. But again, we're trying to understand the essence of the issue here and not get too nitty gritty. Oftentimes when you deal with people in the banking world, they want to get all perfect and everything. That's not what it's about. It's about understanding the essence of these situations and where where the puck or the ball is moving, not where it is right now. So yeah, so like I said, we have about 125 billion in securities right now, and we only have 62 billion in shareholder equity. So shareholder equity to securities is 50%, meaning that if these securities from right now get cut in half, the bank is worth nothing. Gone, just like that. And so these securities have already been getting hit tremendously. And some other metrics that you need to kind of know, and I'll go to them. But one of the big metrics right now is the security yield right now on these two categories, and I did it on a weighted average, is 2.26. And considering that you can go out and get basically cash in the terms of 1 to 3 month T bills of 5.5%, this securities portfolio is extremely underwater. They're losing money. They're not doing well. They've marked down a lot of what's already going on. So there is that. You can only lose so much money. But if this continues and persists, and the Fed keeps raising rates and everything else, and that long end of the curve too continues to go higher, they're in big trouble. They can very easily lose a lot of money here and basically be worthless. So yep, let's keep going down here. Let's talk about what these securities primarily consist of. What, these toxic securities now that we're seen as the golden collateral, what did the bank think was going to be safe? What do they currently hold now, and what are they planning to do with it? So we go to page 12, which breaks down these securities, and here we are. And so as you see here, you see this agency residential MBS mortgage backed securities. Haha, you thought 2008 was dead. Well, guess what? We're back. And as you can see here, and just so you know, so we're looking at the same thing here. This is summarizes their available for sale and held to maturity securities. So we're only going to look at September 30th, because why are we looking 9 months in the past? There's no point. So what are the two main categories that they have right here? Agency mortgage-backed securities that are residential, and take a look down here, held to maturity securities, all agency mortgage-backed securities residential. And it doesn't take crazy math right here to do this, but look at the concentration they have in those securities. Like I said at the beginning of the video, this is $125 billion in assets that they have on their balance sheet. And what is that? 80, 90, yeah, 90 billion in agency mortgage-backed securities that are residential. I mean, talk about concentration risk. I mean, that's crazy. And again, these securities yield 2.26%. Now, this is all of them, but the bulk of them are those agency mortgage-backed securities. So they are just bag holding these things. And isn't everyone talking about how uh, residential real estate looks like it could be the next thing, and all these other things? So this is not a good situation to be in. They are holding these things. So now let's take a look at the next important thing with these particular securities, which is what's the duration, meaning how long do you expect to wait to get the cash flows? And this situation dictates what the bank can do. Can they be flexible? If they had a concentration in these securities, but they were going to get the bulk of their cash flows in the next 24 months or 12 months, it wouldn't be the end of the world. But let's take a look here. So to see how long it's going to take them to get it back. And I believe if we just scroll down here, and here we are, and they're not even trying to hide it. They, at least they were good about that. They didn't really try and hide these things. These are pretty high up on the financials, but I'll talk about another thing uh, at the end of the video. But here we go, right here. As you can see, fair value due after 5 years through 10 years, and then due 10 years later. Look at what we got here. Look where all the bulk is. All these securities are super long duration. They're long end of the curve. The bank is in trouble. They are going to have to wait all this time until these securities start to get more valuable, because they're super long duration. They got to hold them for forever. And look at this huge concentration in held to maturity. That means they're going to hold these things, and to reclassify them from an accounting standpoint, it's going to cause a lot of issues. They're going to have to mark them down, and they're going to show a huge loss. So they have no incentive to change this classification. And I believe it's very difficult to change this classification. So, yeah, Truist is not in a good spot here. They have a concentration in agency mortgage backed securities that are residential, and they also have them extremely long on the curve. So, honestly, one of the worst situations you can be in. And like I said, if they lose 50% of the value from here on those securities, the bank's worthless. It's gone. Done. So, and then two, as I look down here at some of my other notes, their current other comprehensive losses are 16 billion. So if they were to write these held to maturity assets down and pull them into this available for sale, $16 billion disappears from the income statement just like that. Now, that OCI doesn't include the available for sale. I don't believe. I might be wrong with my accounting. I'll freshen up again, but I believe those are above the line. They're not really hidden as much. Usually the held to maturities are the ones. I believe my accounting is correct. So I'm an accounting major, so I should know that. But yeah, I mean, they have a ton of losses on their books and they can't really do anything. So you can tell why um, people are nervous and why the banks are trading so terribly. It's because the people who really know and can sit down here and look at this stuff know, hey, this bank is not doing very well. They can't really do anything in terms of action because they're so strung because it's long in duration. All right, now let's talk more about some of the cash, the solvency, and their ability to meet their deposits and all those things. So if I look here at my notes here, let's take a look. So we're going next to page, well, let's go up. Let's go up. We're going up to page 4 again. Let's go back to the balance sheet here. All right, we're back at the balance sheet. Okay, simple stuff. Simple stuff. You got cash here, and you have interest bearing deposits with banks. So we'll call that all cash. We'll say that's $30 billion. That's all cash. So that's cash that they can take. And if people go, hey, Truist, I want my money, they're going to give them that. Okay. So when money goes into a bank, it's a liability for the bank because they have to give you that money back. And so what they do is they take that money, they loan the money out, or they buy these securities, and then they expect to make a spread based on how much they're paying you in deposits versus how much they're loaning it out. So every time you give your money to the bank owes you. So it's a liability for them. So if we take a look down here, right under the liability section, you see that they have huge liabilities here. Enormous. Absolutely enormous. And it's not good that they have only 30 billion for this, what is that? 400 billion in deposit liabilities. What is that on a percentage basis? 7.5% they can cover. That's ridiculous. I mean, what are we doing here? And these are how these organizations are run. This is how all publicly traded companies are run. They're run with very high leverage because um, they can get money very quickly because they're institutional, investment grade type stuff. And when things do go wrong and the balance sheet gets out of whack, you get into situations like this. And that's why the shares dive and things get interesting. So let's look at some other stuff here. What else are we do? Oh, let's talk about this. The Federal Home Loan Bank loans. Okay, this was something, if you were with me in the beginning of my Twitter experience here in March, April, this was something I honed in on very early. So Federal Home Loan Bank comes out, and what they've been doing is they have been taking collateral that's not really liquid, like these bank loans and things that the banks have that are still relatively high quality here. And then they're giving the banks money and they're short maturity notes, meaning they're doing like 12 months. And so right now, Truist, and here I'll even show you, it's on page 26 here. We're scrolling. Hold on, I'm trying to get the page right. Nope, 22. Here we go. Federal Home Loan Bank advances 19 billion. So remember what I told you. They only have 30 billion in cash. Well, 20 billion of that cash came from it being lent from the Federal Home Loan Bank because no other bank or other institution or whatever you would have said would have lent them the money because they see exactly what I'm telling you right now, that the bank is highly levered. They're going to struggle to meet their deposits if people really start pulling very quickly. And the government steps in and goes, okay, we'll be the last resort liquidity provider with this facility, and we'll help you manage this. The problem with taking these loans is they're due within 12 months. Now, obviously, the government will probably roll these over, but if they are due, the bank's liquidity goes to 10 billion for cash. And when you have 400 billion in deposit liabilities and 10 billion in cash, it gets even worse. And so that's what we're dealing with a lot of these banks, but this one specifically, so you know the actual numbers and you see it here. I'm showing it to you in the 10Q. They're putting this out. Yeah, it's not a good situation. And these management teams don't really know what to do. What can you do? I mean, you have a bunch of losers over here, and then you're trying to keep up the appearance that everything's okay, and you're making the show go, but something's got to give here. Which I'm trying to highlight a lot too from this whole series is that's why the Fed needs to break the economy. They need inflation to come down. Why? Because they need to drop rates, and when they drop rates, all of these securities that they have on their balance sheet, they make money because when rates go down, bond values go up. These type of securities go up in value, and so that would re-solidify their reserves and recapitalize the banks so they can sell some of these securities to pay back the government. That's the whole game here. That's what's going on. So I hope you're getting that clear. And again, I'm showing it right to you. What else do I have in here? I'm about to wrap up this video. We don't really need to get into much more. Yeah, so just so you know, they have 300 billion in loans. These appear to be relatively well performing. I'll be honest though, I didn't really look at this, but I mean the credit markets are really hanging in there. The government's not really letting. Well, I guess things haven't really delevered yet because again, this time the government's broke, not the people are broke yet. At least we're still working our way there. But again, too, if 20% it looks like of the loan values drop, this bank is worthless. But again, if that were to happen, if you were to think that these loans stop performing, guess what that's going to allow the Fed to do? Cut interest rates. And so the shareholder equity would naturally drift up. So that's why I'm not really highlighting these loans here. There's some more complex dynamics there. It's one of those if or then statements. But um, yeah, still, this is a very undercapitalized situation. And they're trying to figure out what to do. So the final note I'm going to leave you with, I think I've hit all of my marks here. So you better understand. So you better understand what's going on here. And again, I'm going to do all the big boys here. Oh, their tier one capital ratio is 9.9, very low. Of the few I've done so far, they're the lowest, along with Schwab. And I'll get into Schwab too. Schwab is a bank, even though it's a secure brokerage and all that stuff. I'm sure. Well, I guess Truist doesn't have that stuff, but yeah, 9.9 from like a pure play bank is not good. I looked at Citi. I think Citi is 13.6, and everyone likes to dump on Citi. So and it'll be interesting. My next video is going to be Citi, and it's not as bad as you would think. So, but my last parting note that I'll give is, and we'll just run up here to the top of the table of contents here. So, to the untrained eye, I've been looking at financials like this for 8, 9, 10 years, who knows how long at this point. But I have very intimate knowledge of how to read these things. I also worked in banks for 10 years. I also helped start a bank. So I understand how all this moves. But to the normal person, they don't know how to look at this stuff. And they might have some idea, but they're not really going to know. They're going to go in here and look at all the financials. And then, they're going to get tired by page, 30 or 20, and they're going to give up. They're going to give up. Well, the big thing that I always look at, and when I always used to do when I was a lender, is when does the management team put all the dirty stuff? When do they start talking about what's really going on? And as you can see here, and other banks are different, they put their management discussion and everything else. Look at this liquidity and all this stuff. Look how low this is on the bottom. You got to get to page, what's that liquidity at? You got to get to page 72 before management starts discussing liquidity. So whenever I see people drop all the bad stuff to the bottom, or management starts talking about the bad stuff at the bottom, it just doesn't look good. It rubs me the wrong way. I've even heard Warren Buffett say, when you read a financial statement, start at the bottom and go up because that's where all the bad stuff is. And this is kind of a instance of that exact situation. So yeah, that's really all I got for Truist. Not a great situation. Uh, at the end of all these, I'll post a comparative chart to show you how all these different banks line up. But as you can see, large concentrations in agency mortgage backed securities that are primarily residential. That's 90% of these securities. They have, if they recategorize those securities, they're going to have to show net income losses of 16 billion. If these securities drop in value by 50%, the bank is worthless. They have 30 billion in cash. 20 billion of that comes from the government in terms of a short-term borrowing facility to pay for 400 billion in deposit liabilities. And then anything, oh yeah, their security yield on all these securities is 2.26%, which is anemic. And all of their, what does it say? 90% of all the securities they have duration that is longer than 5 years. And as you could tell from what I looked at, it was actually longer than 10 years. So Truist, not a good one to start out with. This is not a good situation, but hope you enjoyed this video. I got more coming. Like, subscribe, comment below. Give me some more suggestions on ones to do. Yeah, breaking it down for you, showing you what's really going on here with this whole situation, how managements are showing you but hiding it, all that good stuff. So really appreciate you spending the time. Hope you stay till the end of the video. This is some pretty boring stuff to some people, but to some people it gets you going. It gets me going because it's amazing how crazy some of these management teams ran their business and are in the situations they're in. But yeah, really hope you enjoyed the video. I'll talk to you soon. I got more coming. Thanks so much.